Here's a question that sounds simple on the surface, but gets genuinely complicated the moment you look at it carefully. Are altcoins better than stablecoins? And the honest answer, the one this video is going to give you, is that it depends entirely on what you are trying to do, what stage the market is in, and what your personal financial situation actually requires. This is not a cop-out. It is the only answer that is actually useful. Because the question of altcoins versus stablecoins is not a question about which one is objectively superior. It is a question about matching the right tool to the right job. And by the end of this video, you will understand both tools, what they are, how they work, what they actually return, what the real risks are on both sides, and most importantly, how to think about the choice between them so you can make the decision that fits your specific situation intelligently rather than just following whoever is louder on social media this week. Let's start from the beginning, because if you have spent any time in crypto, you probably have a working definition of both of these things, but the details matter more than most people realize, and it is worth making sure we are building on solid ground. A stablecoin is a cryptocurrency designed to maintain a stable value, almost always pegged 1-to-1 to the US dollar. The three you will encounter most often are USDT. Tether is the oldest and largest, with a market cap of $183.6 billion as of early 2026 and over 168 billion tokens in circulation. It is backed by a mix of US Treasury bonds, cash, and cash equivalents. Tether reported holding over $97 billion in U.S. Treasuries alone as of early 2026, making it one of the largest non-sovereign holders of U.S. government debt in the world. USDC is the second largest, at $75.3 billion in market cap, and is growing fast, up 72% year over year as of March 2026, primarily because Circle, its issuer, became a publicly traded company on the New York Stock Exchange and publishes monthly reserve breakdowns audited by Deloitte. It is the most regulated and transparent major stablecoin currently available. DAI takes a different approach entirely. It is not backed by dollars in a bank account, but by over-collateralized crypto assets locked in transparent smart contracts governed by the MakerDAO community. It has been operating since 2017 without a major depeg event, which is a meaningful track record in this market. The point of all three is the same. You hold them and the value stays at $1. You are not trying to make a return from price appreciation. You are trying to preserve value, to stay in the crypto ecosystem without being exposed to volatility. That is the job stablecoins were built to do. An altcoin is everything else. Every cryptocurrency that is not Bitcoin is technically an altcoin. Ethereum, XRP, Solana, HBAR, XLM, Cardano, Avalanche, and the thousands of smaller projects below them. They have no price floor. They can go to zero. They can also go 10, 50, 100 times in the right market conditions. The return potential and the risk profile are fundamentally different from a stablecoin in both directions. More upside, more downside, more volatility throughout. Now that the definitions are clear, let's talk about what each one actually does with your money, because this is where most people's understanding of stablecoins is significantly out of date. The common assumption is that holding a stablecoin is essentially the same as holding cash. You are parked, you are safe, you are earning nothing. And for basic USDT or USDC sitting in a wallet doing nothing, that is roughly accurate. The dollar value stays the same and you earn zero. But the stablecoin landscape has changed dramatically in 2025 and 2026 in ways that most retail holders have not fully absorbed. Stablecoins are now income generators, not just parking spots, and the yield range, depending on how you deploy them, is genuinely competitive with traditional savings products, and in some cases dramatically higher. Here is the current landscape as of early 2026. On centralized finance platforms, Nexo, Binance Savings, Coinbase, you can earn between 4 and 16% APY on USDC or USDT, with flexible terms and no lockup. Nexo currently offers up to 16% APR on USDT for users who maintain a certain ratio of their native token in the portfolio. On decentralized finance protocols, Aave, Compound, Curve, and Sky Protocol, the yields range from 1.8 to 12%, depending on current borrowing demand. Aave's USDT lending rate sits around 1.8% in low demand periods and rises when borrowing demand spikes during bull markets. And for more advanced users comfortable with additional complexity and risk, yield optimizers, delta-neutral strategies, and structured products can push stablecoin returns to 20 to 30%. The yield-bearing stablecoin market cap jumped from $1.5 billion to $11 billion in just over a year, a signal that significant capital is now actively pursuing these returns rather than sitting idle. The most important recent development in this space is the Genius Act, signed into law in July of 2025, which created the first formal regulatory framework for stablecoin issuers in the United States. That legislation provided the institutional confidence needed for corporations and banks to begin integrating stablecoins into their core operations, and it accelerated the already growing divergence between USDC and USDT. USDC's compliance-first positioning under the Genius Act has driven its 72% year-over-year growth. USDT's market cap has actually contracted slightly from $186.8 billion to $183.6 billion since January of 2026, as some institutional capital rotates toward the more regulated option. Both remain dominant, but the regulatory direction of travel is clear, and it favors the compliant issuers. Now let's be equally precise about the risks on the stablecoin side, because stablecoins are frequently described as the safe option, and they are safer than altcoins in terms of price volatility, but they carry specific risks that retail investors routinely underestimate. The first is depeg risk. Stablecoins are not guaranteed to hold their $1 value under all conditions. USDC briefly depegged to 87 cents in March of 2023 when Silicon Valley Bank collapsed, and $3.3 billion of USDC reserves were temporarily frozen there. It recovered, but for a period of hours, the world's most regulated and transparent stablecoin was worth 13 cents less than its intended value. USDT has faced peg pressure during multiple periods of market stress over its history. DAI's peg has held more consistently, but its dependence on USDC as collateral, the so-called decentralization paradox, means it inherits some of USDC's centralization risk indirectly. The second risk is counterparty risk on yield platforms. Any yield above the basic protocol rates requires you to put your stablecoins into a platform, a CeFi lender or a DeFi protocol, and that platform has its own risk profile. Celsius and BlockFi both offered attractive stablecoin yields, and both collapsed in 2022, taking customer funds with them. Smart contract vulnerabilities, protocol hacks, and governance attacks are documented risks in DeFi. And the third risk, the most insidious and the one almost nobody discusses, is inflation risk. Holding USDT or USDC means holding dollar-denominated value, and the dollar loses purchasing power every year through inflation. At 3 to 4% annual inflation, which is roughly where the U.S. Federal Reserve has been operating, a stablecoin earning nothing is quietly losing 3 to 4% of its real value every 12 months. Stablecoins denominated in dollars are not inflation-proof. They are inflation-exposed in the same way that cash is inflation exposed. Now let's do the same honest analysis for altcoins, because the return potential is real and documented, but so are the losses. The upside case for altcoins is well established by now. Bitcoin averaged 54% annualized returns from 2014 to 2024, outperforming every major traditional asset class over the same period. Ethereum has returned over 82,000% since its launch in 2015. XRP, HBAR, XLM, Solana, Avalanche, and each of these assets have delivered multi-100% returns during bull market cycles. In the first 6 months of 2025 alone, over 26,000 new Bitcoin millionaires were created, people who built positions during the bear market and held them through the recovery. The global crypto market is projected to grow from $2.96 trillion in 2025 to $7.98 trillion by 2030. The upside potential for altcoins positioned inside that growth is categorically different from the return profile of any stablecoin strategy currently available. But the downside is equally real and equally documented. Bitcoin itself has crashed over 80% from peak to trough in every major bear cycle. Altcoins routinely crash 90 to 95%. Of the thousands of tokens launched in every bull cycle, the majority do not recover their previous highs in the following cycle. Some go to zero permanently. The AI token sector averaged negative 50% returns in 2025, despite being adjacent to the hottest technology narrative in the world. The GameFi sector fell 75%. Meme coins, which drove some of the most dramatic short-term gains, produced equally dramatic losses for the majority of buyers who entered after the initial pump. The altcoin market is not uniformly positive. It is a market of extreme variance, where the winners win very large and the losers lose everything, and the difference between the two outcomes is almost entirely determined by research quality, entry timing, and holding discipline. So how do you actually decide between altcoins and stablecoins for your specific situation? The honest framework is built on 3 questions. First, what stage is the market in? During a bear market or a period of sustained uncertainty, stablecoin yields represent real, low volatility returns on capital you would otherwise be tempted to deploy badly. Earning 6 to 12% on USDC in a bear market while waiting for better altcoin entry prices is not a conservative failure. It is an intelligent use of the waiting period. During a bull market, when altcoin prices are compounding rapidly, the opportunity cost of holding stablecoins becomes significant. 6 to 12% stablecoin yield compared to 200 to 500% altcoin returns in a bull cycle is not a close comparison. The tool needs to match the phase. Second, what is your time horizon? If you need this money within 12 months, altcoins expose you to volatility that can produce a 60% loss in a correction before a recovery that takes longer than you have time to wait. Stablecoins, particularly yield-bearing ones deployed on established protocols, give you a return profile that is predictable, accessible, and does not require a specific market condition to perform. If your time horizon is 3 to 5 years and you have done the research to identify assets with genuine institutional adoption and clear use cases, the altcoin return potential over that time frame is dramatically higher than any stablecoin strategy currently available. Third, what is your personal risk tolerance and financial position? This is the question that overrides everything else. If losing 50% of a position, even temporarily, would materially damage your financial life or your ability to meet obligations, then altcoins at a size that creates that exposure are the wrong tool, regardless of the potential return. Stablecoins earning 8 to 12% on capital you need to be stable are categorically more appropriate for that portion of your financial life. The most sophisticated approach, the one used by most experienced crypto investors, is a portfolio that holds both. Stablecoins as the productive cash layer, earning yield on capital waiting for the right entry point or serving a stability function in the overall portfolio. Altcoins as the growth layer, in positions sized to a level where a 90% drawdown would be painful but not catastrophic, held on a timeline long enough for the research thesis to play out. The specific allocation between these two layers is not a question anyone can answer for you. It depends on your income, your obligations, your existing savings, your time horizon, and your genuine, not theoretical, tolerance for watching a number on a screen drop by half. What this video can tell you is that the question is not which one is better in the abstract, it is which combination of both is appropriate for your specific situation right now. And the answer to that question changes as the market changes and as your personal circumstances evolve. The person who was 100% in altcoins in January of 2024, when Bitcoin was at $40,000 and held to the October 2025 peak at $126,000, made an extraordinary return. The same allocation through the subsequent correction to $70,000 represents a 44% drawdown from peak. Both outcomes came from the same decision. The difference was timing and holding capacity.
Stablecoins did not produce either outcome. They produced 6 to 12%, predictably, consistently, without the highs and without the lows, which is not better or worse, it is a different tool for a different job. Know your job, choose your tool accordingly, and review the allocation every time the market phase or your personal circumstances change significantly enough to make the previous decision no longer optimal. That is the complete analysis. If this gave you a clearer framework for thinking about your own allocation, smash that like button right now. Educational content like this only reaches the people who need it when the algorithm sees it performing, and that like is the signal that makes it happen. Subscribe if you want the kind of analysis that explains both sides of every major crypto decision without pushing you toward a specific outcome, just the data, the framework, and the honest trade-offs. Now, here is your comment. Right now, in March of 2026, are you holding more stablecoins or more altcoins, and what is your reasoning? Drop it below. I want to see how this community is actually positioned. And if you know someone wrestling with this exact decision right now, whether to stay in stablecoins or rotate into altcoins during this correction, send them this video before they make the call. Know your tools, use them intelligently,